Yes, the Fed announcing a proposal that was well telegraphed, well expected, that does ease some capital requirements for the biggest banks in this country. It's responsible for the rise that you see there in the big banks over the last few weeks, really, and today as well. So the details in the proposal effectively reduce capital, Tier 1 capital requirements by 1.4% for the biggest banks. They say that would release capital of about $13 billion for those purposes. At their depository institution subsidiaries, that capital requirement would decline in aggregate by $210 billion, but most of that would need to be retained within the consolidated holding company due to the capital requirements. That wouldn't be eligible or available for the distribution to shareholders in terms of buybacks and dividends. Now, what this involves is something called the SLR, the supplementary leverage requirement, the leverage ratio here, which is essentially the numerator is capital requirement, and the denominator involves all assets, including those perceived to be risk-free, such as treasuries or deposits and so forth. And during times of stress, the banks have essentially argued that this ratio binds them to, not intervene in treasury markets during times of treasury stress or taking additional deposits when they might need to do so during, say, COVID, for example. And so this proposal is seeking to solve that. Of course, you do have dissenters in the Fed, such as Michael Barr, who say that this weakens the banking system by releasing all of these capital requirements, creating less of a buffer during times of stress. So not a unanimous decision here, but one that would reduce the aggregate Tier 1 capital requirements, giving the banks a bit of a boost today.